Hello and welcome to this webinar on digital assets and trading, a question of trust. My name is Francesco Guerrera. I'm the publisher of Financial News and the head of International for Barron's Group. It is my pleasure to be your moderator here. And my first thanks go to our partners, SIX. This is the fourth in a series of four on the future of exchanges that we have created with SIX. We had great fun doing it. This is going to be a great one as well. Without further ado, I would like to introduce you to our panel who will discuss this important topic in the next hour or so. First, Tim Grant, head of SIX Digital Exchange. Then Nicole Sandler, head of digital policy at Barclays. And last but not least, Chris Tyrer, who is head of Fidelity Digital Assets for Europe. Welcome. Thank you guys for joining us. And thanks to the audience. Before we start, I want to say the audience has the chance, as always, to ask questions. It's very easy. Just type the question, and I will relay that to the panel. Now, obviously, the first takeaway from this panel, as you can see, and I'm sure it's true of the audience as well, is that being involved in digital assets makes you very good looking. You can see that it's very important. So the audience also, I'm sure, will be the same. I can't see you. It'd be better if we did a live event, but it certainly makes you very good looking. But on the most substantive issues, I would like to start with a general question for the whole panel. And maybe we start with Tim and then go to Nicole and Chris. And the question is, if we talk about trust in digital assets, what is the most important element that is missing at the moment to engender trust among investors and stakeholders in this digital asset? Tim.
Good morning, everyone. That's my kettle making a noise, so I'm going to stop that before we get in more trouble. So good morning, everyone, and it is morning for me. It's 4:30 a.m. because I'm in New York, but don't feel sorry for me. It's what I do every day. Hence, that's what COVID does to you. So great to be here, and great to be here with my fellow panelists, and on this last of our four sessions. So what's missing in the market? I'm going to talk up my own book a little bit here, and it's really, the question is why I ended up taking this role at SDX earlier this year. Actually, if you look back over the last, really the last 5 years, I think it's fair to say that that's been the major focus of the institutional market in this digital asset class. Clearly, Bitcoin and other cryptocurrencies have been around since 2008, but it was really around 15-ish that you started to see a bigger move into the space, give or take. And there's always been this one thing missing throughout, which has been infrastructure. And you can see that actually going back to the original the original Bitcoin days. That whether it be a retail crowd or an institutional crowd, you ultimately need infrastructure. You need things that allow you on ramps, off ramps, places to store what you need, and as you get more and more sophisticated, you get more institutional. And I think the institutional market is really crying out for more of this. Now, we've seen great work. I know that Chris and the team over at Fidelity have been doing great work on creating that. We've seen a lot of other important efforts. We at SIX Digital Exchange also precisely doing that, trying to create an exchange in CSD, but we're going to need more. And I think Francesco, that's the key. We need a more concerted effort around the world to provide institutional grade infrastructure. Because when you say institutional grade, what does that mean? It means regulated, it means trusted, it means secure. It's a funny kind of mix of the old and the new. The new part is the digital assets, the new processes, the new assets, all the efficiencies we can get. The old is we still want it to be trusted, secure, and regulated, just like the first bank vaults. So I think that's what we need, Francesco, more institutional infrastructure.
Great. Well, thank you, Tim. Nicole, from your perspective, what is missing? What is the most important thing missing?
So I agree with what Tim was saying. I mean, I work in regulatory policy, so I obviously focus a lot on regulation. So my answer will not come as a surprise when I say that the regulatory framework, I think, needs to be more fit for purpose. And I say that respectfully to our different policymakers. And I can say that having had conversations with numerous policymakers who also say, we have regulation and frameworks that were written 20, 25 years ago, before we even thought about these different types of digital assets, of which there are many. and therefore the framework may not be fit for purpose. You know, I think back to a couple of years ago when I was having dinner with some friends and they asked me about my job. And I'm not going to lie, like, I'm a lawyer by trade. So you can imagine that in the 15, 16, 17 years I've been working, no one really asked me about my job because they don't think it's that interesting. But Bitcoin was doing this, and you would go to the supermarket and you would hear people talking about Bitcoin. You would have a dinner party and people would talk to you. And I thought, well, this is going to be a problem at some point, because if my friends are asking me about stuff like this, and then my mum might ask me about something like this, our framework probably isn't dealing with all of these issues that are going to follow. So for me, it's a regulatory framework needs to be more fit for purpose to engender trust. And then just as one additional point, education. Like, this is a very complicated area for lots of people. And I think there needs to be a greater understanding of what people are working with to be able to fully understand it. So those are two things I think that will engender trust.
Thank you, Nicole. And Chris, what do institutional investors want to play in this field?
Yeah, I mean, I think, I definitely echo the points that Tim and Nicole have already made. I think that the infrastructure piece is crucial. I think that what is suitable and fit for person for an asset class of, let's say, double-digit billions, when you're catering to retail and you're talking about relatively small amounts of money is one thing. When you scale this up, and we're now over $500 billion in terms of total market cap across all crypto assets, that's a very different market, and it requires very different solutions. And so as this market is becoming more institutionalized, things need to catch up on the regulatory side, as Nicole mentioned, but I think also on the infrastructure side. And I think that is happening, and a lot of that work has been done. And thanks for the shout out, Tim. We appreciate your appreciation. And so I think that we are seeing this move from at the early stages of crypto assets. The companies involved were largely tech companies, and what we're seeing now is that move across, where we're seeing more traditional financial services companies play in this field, such as Fidelity. I think if I had to sort of call out one thing, I mean, one thing that I think has been very noticeable is the SEC systematically rejects any ETF proposals, and one of the things that they frequently cite is the lack of cross-market trade surveillance. And so, I think that, that is something that definitely, I think, would help, with certain regulatory bodies become more comfortable with the market infrastructure and the level of oversight and trade surveillance that's ongoing.
Can I just jump in there, Chris? Because I agree with everything you've just said. I guess the other thing that I would just add is, when I look at what the European Commission have been doing, one of the parts of their MiCA, and sorry, that's Markets and Crypto Asset proposal, is they actually want to have a pilot for DLT infrastructure, because they want to understand it more and look at things which are 5-6 years down the line. I'm not sure if 5-6 years, you need to have a pilot 5-6 years. You probably want something which can be shorter when you're looking at this space as well. But I thought that was a really interesting move by them, which kind of links the infrastructure and the regulatory piece nicely together.
Yeah, 100% agree.
So that's great, because we're going to touch upon all of these subjects in more detail as we go along the panel. We're already getting some questions. Naturally, there's a lot of questions about Bitcoin because it's hovering towards its all-time high. So we'll deal with that, I promise you, in a second. But first, I want to focus on regulation again, and we'll start obviously with Nicole, because you touch upon this. But is the fact that regulation is fragmented and the digital assets are cross-country by definition an issue? So we're getting a Babel Tower of regulation at the moment.
Yeah, I mean, I think fragmentation is a massive issue in this space. I work for a highly regulated multinational corporation, as do others. When you're dealing in this space, and you've got, when I think about, if I were a digital asset, let's say I was a digital asset, got Nicole Sander digital asset, and I'm not the same in different jurisdictions. I either have a definition or I have no definition at all, or my definition changes. And that's very difficult to work with. And I mentioned the Commission earlier, and one of the reasons they actually have put out MiCA is because they were worried about the fragmentation across the EU, and they wanted to be dealing with it. That was actually at the heart of putting out MiCA, or one of the things at the heart of putting out MiCA. They want a framework which will deal with large cross-border markets for crypto assets. So I think fragmentation is a massive issue, because even within the EU, you'll have different views on what a crypto asset is, what you should be able to do in different jurisdictions. And the world is not the same as it once was. Things cross borders in ways they didn't before, and we need to be catching up with that.
That makes sense. Chris, from your perspective, from institutional investor perspective, does that make sense? I mean, is that what's needed?
Yeah, I think so. I mean, I think that look, I mean, we at Fidelity, we serve clients from, all corners of the world. The fact that we don't have consistent regulation, and to Nicole's point, even within the EU, I think it makes things incredibly complex. Right now, before we can serve clients from new jurisdictions, we have to do some jurisdictional analysis to see what the local regulatory requirements are. This obviously has a cost. It also has, a time cost associated with it as well. And so if we want to be operational across all 27 EU member states, it's a huge burden on us. So I think that, if we look at MiCA, I think it's a great step in the right direction. I am, I'm conscious that, we're going to go through a period of comments. Then it will hopefully be passed into, as a directive, and then it needs to be implemented on the national level. So again, I'm aware that this is probably a couple of years out, but it's definitely a step in the right direction. I think, and I don't want to call out names, I think there are regulators that are still kind of hoping that this will go away. And I think that is unfortunate, because I think that what's been evidenced over the last year particularly is that's just not going to happen. And I think it's businesses that want to operate, they just want the clarity to know that they're operating within the correct framework and they're abiding by local regulation. And so giving that clarity, I think, is incredibly important.
Tim, you and SIX are doing a lot on this front. So would you want to talk a little bit about how you're trying to ensure those kind of things that Nicole and Chris are calling for?
Yeah, absolutely. So look, I think the first thing we should call out, and I think this is useful to do to frame the rest of the panel, is let's be clear on the different types of digital assets we're talking about here. Now, I think clearly the crypto rally, or yet another crypto rally, of which there have been many over the last few years, is putting crypto top of mind, and that is not a bad thing. I think that is going to continue to see a shift of institutional money into the space, and that's very much something that we at SIX and at SDX are focused on going into 2021. You'll see some announcements on that coming up soon. So we're not, in what I'm saying, I'm not saying crypto's bad. There's definitely a wave of institutional interest, but let's not forget there's this whole other category of digital assets, which is the non-crypto, right? It's regulated digital assets, it's securities, it's equity and debt instruments, it's loan instruments, it's private equity, it's fund structures, it's structured products, and it's the so-called non-bankable assets like real estate and art. And there's this whole other kind of category, which admittedly, if you look at the amount outstanding in the crypto markets, I think last I looked it was over $500 billion given current numbers. So we're probably, I suspect 500 to 600 billion of AUM, which is good and impressive and important, and I imagine we'll see that grow. I wouldn't be surprised if within kind of 5 to 10 years you see a vast outperformance, or rather a vastly larger size of these regulated securities, and so there's really two angles that we need to think about, and I think the crypto angle is very topical, and the alignment across different jurisdictions is going to be important. We do spend a lot of time thinking about those regulated securities, which in some respects is easier for the institutions to get their head around, because they're already trading debt and equity and all these instruments. You just need to be able to get their head around institutions in a digital form and a digital set of rails, and that requires a slightly different approach from a regulatory perspective. So, when you look at the landscape, and I've been fortunate enough to be flying around the world for the last 5 years talking to regulators and central banks, so it's been interesting to watch the evolution in the last 5 years. It's worth calling out, I have to call out our jurisdiction, which is again part of the reason that I came to SDX. So Switzerland as an economy, as a political system, as a regulatory environment, is extremely forward and progressive when it comes to this stuff. And it has afforded us at SDX and everyone in Switzerland a real chance to kind of move very quickly. You know, small number of decision makers, innovative mindset. I would apply that as well to Singapore. Is a great example of where they're really able to make big advances, and that propels business in those jurisdictions. Now, then you look at the US, which admittedly this year has made some big steps, which has been really great, but it's such a fragmented set of stakeholders that it's going to take years to get that right, and there's everything in between. But the collaboration between the institutions, I think, is what's going to unlock this. And you see the work from the Bank of International Settlements as an example, trying to coordinate between central banks, and we'll talk more about CBDC later. That's the sort of work that we need to see, which is sort of going on the back of what Chris and Nicole said. You know, that if we stay within these jurisdictional silos, we're really not going to be able to get the best out of this new asset class. So we need to get this cross-border activity and harmonization, and hopefully we'll see a lot more of that in the next couple of years.
So we have a question, good question, follow-up question from the audience on this. In particular, he's asking you to focus on Europe writ large, and he's asking you, how does the panel think regulation across Europe will diverge? So with three big blocks, right? Europe, the European Union with MiCA, then FCA in the UK, and then FINRA in Switzerland. Maybe we start with Nicole. And I would add this small follow-up, which is anybody doing it right of those three, and should the others follow?
I mean, look, it goes to Tim's point. Switzerland has been very forward-thinking generally in this space, but Switzerland's a different beast. It's much smaller. Like Singapore, it's much smaller, so it makes it slightly easier in those jurisdictions. Europe's obviously different because there's lots of different jurisdictions that it incorporates. Now, I think that, look, it goes to what Chris was saying earlier. We have a proposal on MiCA, but that's not the final proposal. So there's going to be a lot of work that's going on over the next year, possibly 2 years, depending how long it takes to get to fruition. Do I think at the starting point it's good? Yes. And one of the reasons that I think it's good is because it will kick other jurisdictions into doing something. Because if something actually does come out in Europe that is workable and makes investors and makes people want to do stuff in the digital asset space, if you're the UK, you're not going to sit back and go, well, you know, we've been a bit like this over the last year, and that's respectfully to what's been going on in the UK. You're not going to try and go, okay, well, we're going to continue to do that because we want there to be a market in our closest neighbours, but we don't want to have one here. And that, to me, is one of the biggest beauties with MiCA, is it's taking the bull by the horns. It's saying we need to do something, and we want to be one of the first movers to do so. It might not be perfect what we've put out. I don't think it is, but as a starting point, I think it's reasonable. And I think it will kick others to follow on, and that to me is excellent. But can I just quickly pick on something Tim said about BIS? I think BIS has been brilliant, but I also think that above that, the FSB have been looking at stuff in the crypto asset space, which I think is really essential because we need people at the global level to be pushing this as well.
That makes sense. Chris, what do you think in terms of those three jurisdictions? Who should learn from whom?
Yeah, maybe I'll answer that a slightly different way. I think that, you know, it'll be interesting to see how the SA responds. Like, I mean, clearly we've had the ban on crypto derivatives this year, you know, which is a step in the opposite direction. And so I think that this is going to be one of the first instances that the FCA has a chance to demonstrate how it's going to respond to incoming European regulation and how closely we want to mimic that. So I think, you know, it is an open question. It's not clear. Like, the hope is that from our perspective, that we're not going to see a massive divergence, and that we should see a common approach to how we deal with these assets. And not only does that make it simpler for us to run a business, but, you know, it also it makes sense. I mean, you know, the EU is, you know, the UK's largest trading partner. To have massively different regulation would be harmful to companies that are based in the UK.
Makes sense. And Tim, do you think, knowing the Swiss as you do you think that they see this as a competitive advantage? So they go ahead because they feel that there is an advantage to be gained by being first, essentially.
Yeah, Francesco, you hit the nail on the head of what I was going to jump in and say. Actually, is that at the end of the day, you know, it's interesting when you look at the sort of national and supranational bodies, in theory, that you don't see them as economic bodies. You see them as regulatory policy setters and administrators. But at the end of the day, we have to recognize that these organizations are generally set up and run by the political world, as they should be in Western democracies. And that has to support the economic benefit of the nation in question. And I think that's something that Switzerland has figured out. They made a very bold bet very early on that this could be a differentiator for them to be a leader in this space going into the next decade and the next kind of 20, 30 years of evolution of capital markets. And I think that's something that not only, I think you need that sort of that societal push as well to give the sort of political arms of these organizations the feeling that they're doing the right thing. And I think Switzerland does feel that way. I felt that very, very clearly running SDX, that we have almost a duty to the jurisdiction to get this right, be a leader. And I think there's something to be said for, and I think Singapore sees it the same way. And there's something to be said for that. There is an economic benefit if you really think through where this all goes. What is interesting though is the sort of there's almost a flip side though, and I don't agree with all the sort of libertarian ideals of the original Bitcoin construct, because in many respects I think it ended up being flawed. But I do agree with the notion of democratization. I do agree with the idea of making faster, better, cheaper services available to corporates, governments, and individuals, which is where we get to if we do this right. But that will only work if we get coordination. So there's an interesting dichotomy. You can try and have a first mover advantage, but if you're the first to do something and no other jurisdictions do it, you're actually somewhat limited in how much you can do. So it's a funny dichotomy, and you kind of have to get both sides of it right, I think.
That's why Europe's so interesting. That's why MiCA's so interesting, because it's a first mover with a lot of different jurisdictions. I just want to make one point clear, and this is not aimed at Switzerland at all, so I'm giving that disclaimer. It's great to be first, but you want to be first if you're doing something right. You don't want to be first if you're doing something which everyone's going to turn around and go, that isn't actually how we want it to work, or there are going to be concerns, and actually what's happening is it's taking away from the trust that we were talking about earlier. So it's a very difficult balancing act, but you want to be first of something that is actually going to make things better. You don't want to be first of something someone's going to go, oh, I like this asset class less than I did before, because that actually then hinders us going forward. And that's not aimed at Switzerland.
Makes sense. Let's stay with this, but moving the focus slightly onto the institutional investors market. And I would like to start with Chris here, obviously. What is it that they need to see in terms of, be it regulation or products or other issues, to get really comfortable with the these asset classes?
So if we're talking about crypto specifically, I think there's a couple of things. I think that we've talked a lot about regulation. I think that's definitely important. I think that people need to understand, how they need that clarity. I think the other thing that we've talked about as well is infrastructure. And that has been something that, when you look back at the bull run that we had in 2017, the infrastructure just wasn't there. I mean, we didn't have institutional grade custodians. We had liquidity venues, but the advances that have been made on that front have been vast. And you look at the how quickly institutional grade exchanges such as LMAX have how quickly they've developed, moving into now they're frequently the BTC USD most traded, that's the pair most, it's the exchange with the most volume on that pair. And so I think that all these things are very helpful, but I think also as well, from the institutional perspective, I think that it's an education process as well. I think that in fairness, if you look, I don't think that if you looked at institutional investors at the tail end of 17, they were kicking themselves saying that they ought to have been on this bull run, because it was just, looking back to 2015, 16, it just, the infrastructure wasn't there, but also the knowledge of it as an asset class, as an emerging asset class, just wasn't there. I think what's happened since is people have felt that they've needed to get up to speed, and people are a lot more familiar with what this actually is and what it can be and where this is going. And I think that, you fast forward to 2020, and obviously we've had a very, very unusual year, but we now have, I think, massive macro tailwinds behind this market. I mean, in terms of the central bank balance sheet expansion that we've seen, the fastest pace ever in history. And I think also as well, you look at asset managers, and, it's difficult to know what to do right now. I mean, we have equity valuations at enormous levels. I mean, PE ratios are kind of the third highest they've ever been. We're already pricing in this massive recovery when we were already pretty late stage in the macro cycle going into this. And so, I think, and then you look at, the bond market, and, we have $17 trillion worth of global debt yielding negative rates. I mean, people looked at gold, I'm a commodities guy. I traded commodities for 17 years. People always used to, institutional investors would look at gold and deride it because it had no yield. Well, guess what? In a negative yield environment, that's a feature, not a bug. And so I think that, we've obviously seen this, massive reach for hard assets. Gold's been a beneficiary of that. Bitcoin's obviously been a huge beneficiary of that. And I think that, we're really just starting to see the green shoots of this adoption. I mean, we're still in the very early stages of this, I would say.
Makes sense. Tim, what do you think from your perspective, talking to these people, and what is it that they want from you guys?
Yeah, so I think it's important to segment between the sort of crypto and the regulated securities. On the crypto side, I echo everything Chris said. They just want secure access. I want to be able to take my bank on, either if it's on behalf of my customers, or if it's an asset manager, give me the way to securely get a handle on this, to get the AML KYC right, to have the level of security and trust that I'm looking for, and be able to get in and out of the market and execute properly. And that's been coming together over the last kind of 5 years or so, since the last bull run. I agree that there's been a lot of investment. This is great. We're seeing a lot of new exchanges out there. They tend to be a bit more grown up, but you're seeing those intermediary pieces of the puzzle around the execution venues to allow the investors to get access. We at SDX, as an example, have an investment in OmniX, which is precisely set up to allow asset managers to get access to these markets, and we're moving in the direction of allowing that for banks as well. So that's the question, I think, for crypto. That the asset class has its own sort of features that are seen as positive, and it's in a classic portfolio construction mechanism. There's plenty of evidence to suggest that it adds to diversification and gives you yield and all that stuff. So I think that's the crypto stuff. The non-crypto stuff, again, the bonds, the loans, etc. There's no volume to speak of today, really, but it's going to be coming. And I think it's a chicken and egg. If we, as an example, deliver SDX, and we will, by the way, the next year, then we should start to see an opening up. We've got a lot of sort of pent up demand. Now, then it's a different question: is, well, why should I do a digital bond rather than just traditional, issuing a digital bond or issuing a bond in the traditional mechanism? Why should I do a digital equity when I've got a pretty efficient market in the equity space? And then we're in a very different discussion. It's not about the asset class per se, the underlying. It's actually a long-term infrastructure and efficiency play. And I think over the last 5 years, you've seen a lot of the biggest banks and asset managers plow time and money and people and energy to understanding it. And there are still some open questions, but at this point, if you really know your stuff, you recognize that there's a longer term play here. In 10 years' time, we have an opportunity to really genuinely rethink, reimagine, revolutionize these capital markets to be more efficient, less jurisdictionally limited, to be able to look across asset classes in a seamless way, to do asset servicing in a seamless way, to have new trading models, and sort of have a new and liquidity becomes sort of the holy grail, and new forms of liquidity. Can you do is it relevant to do 24/7 trading as we see in the crypto markets, in the regulated securities markets? Like there are some unanswered questions, but I think we see the promise of why the institutional investors are now starting to think a little bit long term. If everybody wants value in the regulated stuff next year, everyone's going to be disappointed. But the spoils on a 10-year horizon are really meaningful, Francesco.
Understood. Thank you, Tim. Nicole, do you agree? I mean, that's the holy grail, as Tim said. Liquidity is the holy grail, and then everything will fall from that.
I mean, look, at Barclays, if I take it from the crypto asset side, we're not proposing that institutional investors invest in crypto assets. You know, the lack of regulation and the high volatility makes it difficult for us to do so at the present time. You know, Chris referred to, mentioned it in the same breath as gold. I've heard that lots and lots of times, and on one hand I understand it, but on the other I think gold is tangible. I understand what gold is. I understand what I can do with gold. When I look at crypto assets, of which, let's be clear, there are numerous, over 2,000, and there will be many more, putting aside all of the digital asset stuff that Tim was talking about, I don't necessarily know what it is I can do with them. Like, so when I'm trying to understand what it is it a store of value? It's at this point, I think it's tricky, and that's what makes it difficult for us from an institutional investor perspective, because there are lots more questions than there are answers at the moment. So the education point is obviously key here that Chris mentioned earlier.
I could just jump back in there. I mean, yeah. I think some of these questions are very interesting. The volatility question is something that is, cited quite a lot. When you look, I mean, somebody did put something out the other day suggesting that 25% of S&P stocks are more volatile than Bitcoin this year. I mean, certainly Tesla's been way more volatile, and so I think that volatility is one of those things that's easy to point to. It's been an exceptional year. I think that in terms of tangibility, again, an interesting point. I think that that's a generational thing. Like, I mean, and I admit this. I probably bought CDs for 5 years longer than I should have done, and the reason being was I couldn't wrap my head around the fact that I was paying for something but not receiving anything physical that I could hold. Like, I wanted the CD tray, I wanted the insert. I mean, I never looked at it; it just sat on my shelf. But it just didn't feel like I was getting somehow value for money by buying music digitally. And I think that's just something that we've come around to. The idea that something can be, non-corporeal and have value. I think that there's a generational thing where I kind of struggled with that for a little bit, and I continue to, when we're talking about a store of value, I think it's a leap further still. For a generation beneath us, that's just not a question. Like, I mean, in terms of I was looking up the other day, like, what the most expensive digital asset that had ever been sold in a game. And there was a nightclub that was sold, I can't remember the exact game now, that was sold for $650,000. And this was like a business that was sold, a digital business that existed only in a game. And so I think that there's a generation beneath us that don't have the same hang-ups about something that is non-tangible and having distinct value. And I think that to the point about gold, like, and people do talk about this a lot, and I think that, I mean, for me personally, saying that Bitcoin right now is a store of value is a misnomer. Like, nothing that loses 50% of its value in 2 days in March could really be described as a store of value. I don't think people are exiting equity positions and riding out periods of market volatility and hiding out in Bitcoin while they do so. Like, that's just not happening. And that's traditionally how, people aren't using Bitcoin to preserve purchasing power. And so I think that that's changing. I think that when you look at the characteristics of Bitcoin, you could argue that they outperform gold on pretty much all of them, or a lot of them. And I therefore think that the way I view Bitcoin is therefore a call option on its future use as gold, as a digital store of value. And with regard to there being 2,000 crypto assets, if you look at the fees that are generated per week, and Larry Chermak from the block has done a good job of highlighting this. You have Bitcoin and Ethereum, which are in the double-digit millions per week. You very quickly get into the single-digit thousands. So I mean, there's a ton of stuff out there. Very little of it actually trades at any scale and has any discernible value or developer mindshare.
So I don't disagree with any of that. The only thing I would say is, so I also remember having records, then CDs, and then stuff on my iPhone. But I still had the same thing at the end of it. At the end of it, I was listening to music. I knew exactly what I was getting. And that's where the difference lies. And whether that's generational or not, I still want to know what it is I'm getting. So, and I agree, 2,000 different crypto assets, of which only a few are doing X and Y. But when we're looking forward, when we're saying, let's look, you're saying it's a call option for the future, but any one of those 2,000 could potentially also be a call option for the future. So that's why I like to differentiate between them, because I think people only think of really Bitcoin and Ether, or quite often when they're thinking about cryptos. And it's not just about those. There are lots of different, and also to be clear, I'm neither pro nor against cryptos. So I don't want to sound like I'm being negative towards them. I'm not. I just want to understand what it is that we're dealing with. And at the moment, I think because of all of the challenges we've mentioned earlier, it's not clear. But I do like this call option for the future that you noted, Chris.
Francesco, I'd love to jump in this. I can't resist it because I love this particular topic. Chris, you're absolutely right. I still buy CDs. I still buy vinyl. I'm a DJ. When I DJ, I DJ on all formats, just whatever works at the time. But I kind of had an interesting. I remember saying this a few months ago when we were talking to institutional clients about debt. It was just about the classic sort of digital bond. I'm like, well, think of it in movie terms. You had your classic film, and then we had VHS, then we had laser discs, then we had DVDs, then we have Blu-ray. Now we have digital format. But the film, the Casablanca is the same movie, regardless of the format, all the way through. And then the question becomes, well, what is it about the transport mechanism that makes it better or worse? Because the underlying movie is the same. Doesn't matter what way you look at it. Without sort of beating the analogy to the ground, there are always answers in every step of the way. And I think what we're saying here, and I kind of think, and Nicole, I think you're right to have said it, is that we're talking about new kinds of movies here. These crypto assets are new kinds of movies. Now, again, I am also crystal clear. I'm not negative on the space at all, but it is a new kind of movie. It's a new kind of understanding you need about what this underlying is, and the world is going to have to get its head around it. And it is demonstrably so. And I think it is very interesting to look at some of the dynamics in liquidity that you're seeing in the crypto market this year. It is we talk about it, we joke about it's not your grandfather's crypto market. It's not the crypto market of 3 years ago either. It's a very different activity, much more institutional. I read something yesterday that it's most of the rally is driven by 9 to 5 trading in which would tell you that it's more of an institutional trading mindset. But it's a different movie. It's a different Bitcoin's a different movie. It's not that they've never made movies like this before, and that's always going to result in sort of people having to get their head around it. But I think they will.
So on this topic, by the way, I did read the sleeves in the CDs, so that makes me one of you. But so on this topic, Chris, how important is having this ETF then? That the SEC has rejected so far, but the industry has ETNs, ETPs. But how important is it to engender trust to the topic, but also to do what Tim was talking about, helping people getting their heads around it?
Well, I mean, just because you put a different wrap around it, I don't know that it changes the underlying and people's understanding of it. I would say that, is it important to, I'd say that it's more, an ETF is more important just to make the market access easier. I mean, you can, if you're, if you're a wealth manager and you would like to put a proportion of your clients' assets into crypto right now, you now have the infrastructure in place, but there are still complexities. It's where do you get the price feeds from? Like, which bucket does this fit into anyway? Is this an alternative? Is it a commodity? Is it a venture bet? Is it, and so there is, what do we do with 8 decimal places? Things like this, sound trivial, but they're not, and they need to be addressed. Now, an ETF would enable people to gain access through traditional platforms in a wrapper that they're very comfortable with. So I think it's meaningful for adoption. I don't know that it's necessarily, but you need to have crossed that bridge already. You need to have appreciate the value. So I don't think it's going to be. It's an improvement in the client experience and the means by which you can get price exposure. It doesn't affect the underlying properties of the asset.
If we move away just for a second from crypto and we talk a little bit about the other assets that I think Tim mentioned, right? What is so you admitted that there's not much liquidity at the moment. What is the sell that you guys make to an institutional investor to say trade it in this DLT infrastructure as opposed to the traditional infrastructure? What's the advantage to doing that at the moment?
Well, look, I think it goes back to what I said earlier in the sense that there's this it's almost like there are perpendicular needs in the crypto versus the non-crypto market. In the crypto market, it's the new movie you have to understand before you're ready to go and buy the asset and watch the movie, as it were. But here it's movies is well understood, but it's a new mechanism. It's like, well, it's again, I think maybe it's to some extent like Chris said, are you going to hang on to, is the bond market going to hang on to the CDs and trade them in a traditional form for how long before it realizes that there's a vastly more efficient opportunity with some certain DLT enabled elements. We build our CSD. And when we go live, we're going to have a license for a CSD, which is exactly the same as the one that is currently operated by SIX, right? So the SIS unit that we run within Switzerland, which is meaningful CSD, it's the same license. It's not a lesser license. It's the same level. Now, in order for us to get that, it's been a lot of time and money to get here. But what we will have will be the first CSD at that scale where we can actually create digital assets on a private blockchain, which happens to be, in our case, on the R3 Corda Enterprise DLT. And that's going to allow us to do lots of very cool things. However, it's not going to give us a huge benefit on day one. And that's sort of, therein lies our big challenge. And it does all come down to liquidity. I genuinely believe at the end of the day, whether it be crypto or non-crypto, and in any asset, it comes down to how liquid can you make it, because the more liquid you make it, the more value ultimately it brings to an ecosystem. So we're thinking a lot and spending a lot of time thinking about global liquidity. That's our goal. And so back to your question, Francesco, when we're talking to a large Swiss bank and they're saying, why should we get involved in the bond markets, digital bond markets? You say, well, look, if we do this right, at some point 10 years from now, they're going to be, think of it as Japan, Singapore, Australia, Middle East, Europe, multiple locations in Europe, probably the UK, Switzerland, and somewhere in the EU, North America, South America, all connected on some sort of consistent set of rails where we're no longer having, equity and bond markets and different markets that all operate in different rails. They'll all be on some level of commonality. And that's going to allow all the sort of underlying magic that DLT can bring, the mutualized processing layer, and that has vast amounts of efficiencies. It has data and analytics components to it. Like, all of that is what we get if we start, but we've got to start. And actually, the good news is I'm delighted to say that I think we're starting to see that now. We're seeing genuine institutional buy-in to this journey. And I suspect if we would do this panel a year from now, certainly if we do our jobs right, but it's more than just us. There's a lot of players on the world looking at this. We'll be able to point to some real significant, large-sized, not sort of issuing a bond to myself just to prove that you can issue a bond. Like, we've done that. But issues coming to market, having some secondary activity, and actually demonstrating the ignition of a marketplace, and then liquidity will follow. But if we can connect all these locations, if a Japanese investor is able to invest in some South American piece of paper because we've created that and we've got the jurisdictional harmonization on regulation, that's a new kind of form of access to capital formation that has a material effect on the economy. And so that's a big hand wavy story, and you've got to be able to sell that, right? But I think that's what it comes down to, Francesco.
Thanks. Chris, do you agree? Are you starting to see this liquidity moving into this assets?
Yeah, I mean, I think that we've definitely, I think people have been sort of disappointed by the process of tokenization. I think it was like 5 years ago, it was, Jeremy Allaire was like, tokenize the world was his kind of, was his mantra. And I think that people have just been expected a lot very quickly. But actually, in this situation, the technology is actually the easy bit. It's then sort of trying to work out how you shoehorn new technology and new infrastructure into regulation that didn't envision it. And so, and interestingly enough, so we speak to a lot of the banks about, where they are. And to be clear, whilst the business that we've built up at Fidelity is centered currently around Bitcoin, and we will launch support for Ethereum in the not too distant future, we're not called the Fidelity Crypto Company. This is digital assets. And so, we always have a very close eye on what's happening in the tokenization space. And fundamentally, we believe the crypto assets will persist and they will become increasingly relevant. But we also believe that this is going to be a replacement infrastructure in a lot of ways. But what we're starting to see, though, and I completely agree with Tim, is I feel like we are now starting to turn the corner this year particularly. It feels like we're coming out of that period of experimentation where people are running proof of concepts necessarily to understand the technology, but without really any sort of commercial application. It's an experiment, it's a POC. And some of the work we're doing now, where we're in the early stages of partnering with in particular one European investment bank who has, and this is I think incredibly interesting. They've effectively trying to phrase this so I don't give too much away, but they have realized that through the process of tokenization, they can disaggregate the certain life cycle events, and by doing so, they can outsource parts of that they don't want to do. And so, and because this is the nature of the product is reasonably self-contained, they're able to realize efficiencies that they wouldn't be able to by issuing this product in a traditional way. And I think that's incredibly interesting. We talk about the sort of, the evolution of back office systems, and that's great. And, in the early stage of the internet, everybody could sort of foresee that you could put a newspaper online. But what we couldn't foresee is that the way we would consume news would completely change. And I think that this is some of what we're starting to now sort of see is as people are experimenting and have greater familiarity with the technology and what it can achieve, that there are certain unintended consequences or certain things that you can facilitate through the process of tokenization that you just wouldn't be able to elsewhere. And that's really exciting, I think. And so in terms of large scale, like global securities markets transacting on blockchain, yeah, I think we will get there. I think we're going to get there. I mean, there is too much in the way of efficiency savings to be made not to, but it's a process. You need a lot of people to come over the line at the same time. Some of the projects that we're seeing elsewhere, I think, are have the potential to move slightly faster.
Interesting. We actually have a question on the audience on this back office issue that you touch upon, Chris. Which the question is, how do you think the back office is going to evolve if you're starting to have a mountain of digital assets being traded all of a sudden, so processing, clearing, and everything else? I mean, maybe that's a question from Tim. How are you guys preparing for that explosion?
Yeah, the way we see it is, and I agree with everything Chris just said. Actually, it's the trajectory is starting to become a bit clearer. Is that I say this a lot, the breakdown of silos, and I think it's a bit of the theme that Chris touched upon, and we've all been touching upon, which is, generational shifts in formats and capability. There are leaders and laggards. There are people who hold on, and there are people who go move early. And there's the classic bell curve, and we've all seen it, the early adopters and all that stuff. And that, that's just generally true. But if you think beyond, if you try and think beyond, and the bottom line is nobody knows quite how this ends up. That's the truth. We don't quite know how this all ends up being formulated. And I don't think that's a bad thing that we don't know. It's because we've all lived through in our lifetimes when the internet came in, and none of us knew that Uber was going to be a thing. But if we'd thought about it, it would have been pretty obvious. So it's because we didn't know mobile phones were going to be a thing when the internet came out, and all that stuff. And so, the pace of change and development and innovation is such that, we can't all sit here and say 10 years from now we know what's going to happen. But here's something I think we know that is likely to happen. It's the silos will break down. And I've mentioned jurisdictional silos. I mentioned different asset class silos, but there is another silo which is direct to your question, which is and you were kind of alluding to it, Chris, is that there are banking institutions that are doing the same stuff in all those different institutions, and it's not logical that they're all doing the same thing and paying for it. And it's not just banks, it's lots of different types of big financial institutions, buy side, sell side, infrastructure, the whole shooting match. And at some point you get to mutualize that. And it's not counter. I've had this argument a few times. Well, you don't want to that's more centralization. Well, I'm not going to get into the CFI DeFi debate because I think that's seriously pointless. I think it's best to get to a point where we're developing faster, better, cheaper products and services for everybody in the marketplace. And whether it's CFI, DeFi, or somewhere in between, it's where it's going to end up. But it will mean that we'll have sort of a gray area between regulated and unregulated infrastructure. If you're used to getting a level of trust and security in your unregulated infrastructure, well, why wouldn't you apply that more broadly across the board? So to directly answer your question, we are thinking about actually extending beyond the classic sort of realms of a financial market infrastructure player, which is what SIX is, and actually thinking beyond that. Like, what can we do to help run pieces of infrastructure for the industry where it doesn't want to do it anymore? It doesn't want to pay that. It wants to outsource. And what can that do to kind of connect the dots and again break down more silos? And that's very much the kind of conversations we're having with the banks. I think certainly by the end of this decade, this will have played out and you'll be able to demonstrate it. I'd like to think within a couple of years we can show that. But interestingly, to take it all back to crypto, I actually think that's where we'll show it first. I think that's where everyone will look at it and go, oh, I see. If we can build it that way, we don't need to do it the 20th century way.
Interesting. I'd like to spend a couple of minutes, because we only have 5 minutes left, on central bank digital currencies, right? A bit older age at the moment, because the European Central Bank has been talking about it. Do they help? Do they hinder? Do they validate what you guys are trying to do? Do they compete? Maybe I'll start with Nicole. What's the point of it?
Well, look, it depends. When we're talking about CBDC, it depends also what we're talking about. Are you talking about a retail CBDC? Are you talking about a wholesale CBDC? The CBDC that is only done by the central banks? Is it a public-private partnership? Is it a wider ecosystem play? The ECB does have its consultation out at the moment, which I obviously welcome. I have to say that I have a lot of questions which come off the back of the questions they ask, but they're not the first central bank to be looking at CBDCs. I mean, the Bank of England put out their retail CBDC consultation paper in June. I can't remember if it came out in June or it closed in June this year. So I have to say this year's all merged into one very long month since the start of COVID. But you've also got, what's been going on with the e-krona. So to me, it's the first question is, what is it we are talking about? And what is it you want the CBDC to do? And who is going to be incorporated in the CBDC ecosystem? And you have to go through all of that. Now, do I see benefits to CBDCs for a consumer? Yes. I mean, COVID has shown that people are becoming more cashless. That's the other thing I'd say. Like when you think about the e-krona, that makes sense because you're in a jurisdiction where I think it's 70% cashless. In other jurisdictions, that's not the same case. But with COVID, you are seeing more people looking at not using cash. So that's one of the things that has pushed the need to look at something like a CBDC. There are other things. I mean, let's be honest, Libra has also pushed central banks to be looking at CBDCs as well. I don't want to have a conversation about Libra, but there are causations to why people focus on these things. So it really depends what it is the central bank is looking at. I actually think wholesale would probably be easier. Like if I think about a retail CBDC, and whilst I see benefit to it, would I really want to, at a central bank, be dealing with customer complaints? Absolutely not. That's not something that they're going to be doing. So there will be a need on a retail CBDC to be working with lots of other partners, because I just see lots of areas which you will not, as a central bank, want to be dealing with. But I think it's something which is really interesting. I think it's going to take a bit of time, to be honest, to come to fruition. But I think it's interesting and something that I would like to spend more time on, and I think the market should spend more time on. And I welcome the fact that you've got a number of different central banks. So I think Tim mentioned this earlier on CBDCs that have been working together to look at central bank digital currency, so it's not so siloed. And I think that's really important. You've also got the US digital dollar work that's been going on separately in the US with ex-CFTC chairman and others. So I think that's also something that people should be looking at.
Chris, what do you think?
Yeah, I mean, I agree with everything Nicole just said. I think that it's a lot of this has been prompted. I would say, in addition to Libra, I'd add China into there as well. Yeah. I think the implementation is going to be crucial. I'd say also it's a key ingredient for the success of long-term success of tokenization as well. I mean, that's where you can get the real, some of the real red cap benefits is if you are able to do true delivery versus payment, and you have, a CBDC that you can swap out for, whatever securities you're trading, and in that sense, you don't have these forward liabilities in your and so on and so forth. So I think that it's a space that in the world of central banks, where things typically move quite slowly, it seems to be moving quite quickly, and I think it's a positive development for not only for tokenization, as people, it's another leg to the stool, and it helps us on this journey towards more and more assets trading on blockchain.
Tim.
Yeah, look, by hook or by crook, somehow I ended up being a bit of a fixture in the CBDC world. When I was at R3 a few years ago, we started the OG projects. We started Project Jasper with the Bank of Canada and Payments Canada and the banks there early 2016. It was really one of the very first sort of collaborative efforts in one jurisdiction. Then we started Project Ubin later that year, which still goes strong in Singapore, Lion Rock in Hong Kong, Inathon in Thailand, and others. And we've seen many others. And it's interesting, you mentioned right at the beginning of your question, Francesco, it is a hot topic. It has become a hot topic, but it's actually, it's a hot topic again, because everyone was banging on about it in 2016, 17. And I had my own part to play in that part of the cycle. What I'm excited about now, though, is the technology has evolved. It is scalable. It is deployable. We can get it into production, and we at SDX have shown that. We've shown that in our work with the SNB and the BIS, and I'm excited actually at the beginning of next month, not long from now at all, we'll be coming live with our paper with the BIS and the SNB. And I think that'll be another one of those landmark papers. Like, okay, we built it. We built it on real infrastructure, which is the exchange and CSD infrastructure we're going to go live with next year. And this is it's not so much what we've done now that's exciting. It's where we go next. And I think where we go next is we start to work towards genuine policy changes, and that's what we need. We need to see the decision makers at central banks actually take that key leap to issue wholesale. And I agree with Nicole. I'm just talking about wholesale here. I don't go near the retail debate because I think it's interesting but complicated for lots of reasons. And but from a wholesale perspective, it's happening. And Chris is right. This is a piece of the puzzle. It unlocks the future. It unlocks value. Cross-border CBDC will be super important to see in the next couple of years. That we see different jurisdictions actually working on integration, interoperability, which is an overused term, but we need it here. So it's needed. It's a central piece of the puzzle, and I think we're about to get there.
Yeah, well, that's great. We basically out of time, but there is a question from the audience that I do want to ask. It's one of these cliffhanger questions, so it's just a yes or no question from you guys, and yes or no answer from you guys. This member audience is asking whether you foresee a future where cryptocurrencies will displace traditional currencies in retail, right? In buying milk and bread and stuff like that. It's a yes or no question. So relegating the old currencies over time to extinction, essentially. Yes or no? Tim?
No.
Christopher?
No.
Nicole?
No, because not everyone has access to digital.
There you have it. So on that note, we could have gone longer. Before we go, I need to ask this question because we shouldn't let it lie. Tim, are there any Spotify playlists that we can follow of your or stuff remixed by you as a DJ?
Yes, well, actually, you know what? If you keep an eye on my LinkedIn, I do my Sunday vinyl service every once in a while, and you can get involved and watch me spin. Yes, thank you
Brilliant.
for that public service announcement.
So the audience knows to do on Sunday now. So thank you so much. But seriously, thank you so much for a fantastic panel. Thanks to the audience for great questions. We have to thank Six for this panel and 3 others before. We had great fun doing it. Hopefully it was great fun watching. Remember that this is going to be available on demand from tomorrow on the Financial News website. So if you enjoyed it, tell someone else. They can enjoy it as well. And hopefully we'll do this again. Tim set us the challenge of doing this again in a year to see how things have changed. It'd be great to do that. But I want to thank the panelists, Tim Grant, Nicole Sandler, Christopher Tara, and wish you a very good day. Take care.
Thank you.